For Wall Street Media, this is Marley. I'm here with Doug, and we'll help you make money in the stock market with information you can't get anywhere else.
And we've got a good one that you can't get anywhere else today from Dahlman Rose. And we've got the CFO from General Maritime, right?
Jeffrey Pryber. Same.
Fantastic. Yeah. This is from the conference today, kids.
It is.
Take a look.
We have Jeffrey Pryber, like I said before, who's the CFO of General Maritime, and their ticker is GMR. Discusses the weak refining market that helped tanker shares to price in the spot market strength seen during late 2007 and early 2008. Here it is.
Typically, it's a seasonal market, as many of you know. Last year, the fall season was much delayed, and the pickup in the market only came in Thanksgiving time when, in my opinion, what the major factor was that OPEC felt at the time that inventories had declined enough that they were willing to send more oil, which happened by way of primarily, or at least a major force or impetus for that was Saudi Arabia increasing its discount on oil, which had the effect of fixtures of VLCCs initially, and then later other mid-sized tankers picked up in the end of November, and rates spiked, as you see here, up to over $200,000 a day, probably a quintupling of rates from just the week before. And that rally eventually spread to the mid-sized tanker market by the end of the year. So we entered the year with a spike in rates. Where are we today? Looking at the year for 2008, the IEA has tweaked its forecast down twice so far for this year, but still looking at a 1.9% increase in oil demand, which is higher than 07, even factoring in some slowness in the U.S. We think that there's probably risk that gets tweaked down further from there, and that ultimately the demand may be a little bit lower. But it's in any event, even if it were at 1.9%, we would have expected that would have left us below the in demand below the supply of vessels coming on in terms of gross supply of 4 to 5%. There's usually a factor of somewhere between 1.75 to 2.5 times on a percentage basis oil demand growth and barrel growth and deadweight tonnage. So you can take that almost 2% IEA growth and then say double it. You might get to 4% tanker demand growth, but again, that's a little less than our supply. So our initial view had been to expect a little bit softer rates for this year versus last year, but we've modified that, and just repeating what we said in our most recent conference call is that we said all through last year that the wild card on that forecast would be deletions from the fleet, and that can come from voluntary scrappings by tanker owners or conversions or other ways to exit the fleet to either to FPSO projects or other energy projects or dry bulk ships. And we now see that there are enough expected, already contracted, already happened, or solidly expected conversions, and the numbers are not certain enough to pick one, and we don't endorse any one number, but we think there'll be enough exiting from the fleet from these various factors that it will soak up that 4 to 5% increase in supply, and that in fact demand and supply will be fairly well balanced this year for tankers. So we expect a rate environment that on average looks about the same or possibly even better than 07.
Hey, now let me tell you, this is what we do. We webcast the CEOs at this conference, and we're going to do how many this year?
20,000.
Yeah, so a few, right? And we picked the highlight for you right there, and then you can listen to the whole thing if you're interested, and you can also see and hear a bunch of others there as well, right?
Yeah, it's at wsw.com/webcast/Dahlman, which is DAHLMAN.
Now, you can follow us. We're the only ones that you're going to see. We're not actually journalists, and we actually decline the title because we actually do put money in the market. And you can follow what we do for free at covestor.com.
Yeah, we have a whole portfolio that you can look at, and on the show, Doug will say, I like them, and buy it, and you can see it appear in our portfolio.
And that's what we do. And that's why I think it's more valuable is you listen to the CEO yourself. You don't listen to an analyst or a journalist who doesn't own any stocks. I mean, it's the most ridiculous thing I ever heard, right? Oh, I'm going to learn how to cook from someone who doesn't cook at all, right? From someone who orders takeout or something, okay? Click the feedback. Tell us, like Marley said, if you're interested in this or what you think of the stocks or what you're buying, what you're selling.
Yeah, we love to hear from you. We often do shows, too, just on feedback alone.
I'm going to buy some of the stocks from Dahlman Rose, okay? And German Mike, you might want to look at these guys, GMR. German Mike's our CTO. And he's a conservative investor. He's not the happy triggers that I'm a little too much.
He's a German, of course. He's a conservative.
This German. These guys are like they pay a 9.1% dividend, and they're at a 52-week low, and they're in energy. I think I'm definitely buying some that we webcast from Dahlman Rose.
Absolutely.
Okay. And you can follow it on covestor.com. And these are all free things. We're trying to do you a service. I've been on Wall Street for 10 years, and I know the way that I do things is I like to listen to the CEOs and get a feel for them, and the CFO, from this one, and see what we think about it.
And hopefully he's right that there will be a tanker increase in need for tankers this year.
Yeah, he said prices quintupled in November. That doesn't have to happen too many more times to make us all very happy little bunnies.
Well, the happy little bunnies are here every day at Wall Street Media. You can find us at WSMCO.com. Thanks for joining us.